you don't want to get caught in value trap type situations. That said, for investors that maybe not looking out over the next quarter or two, but for investors that actually have a 3 to 5 year time horizon, we do believe that there's actually a lot of good value to be had in China. You've got a circumstance whereby U.S. markets are trading at about 30% premium to their long-term average, whereas China is trading at about a 40 to 50% discount to its long-term average. It's trading cheaper than the broader emerging markets. And you're starting to see some green shoots. I mean, that economic growth has actually picked up in the latest quarter. The PMIs for factory output has actually moved into expansionary territory. And it just seems that, maybe we might be in a circumstance where a lot of headwinds have turned to tailwinds. The reopenings post-pandemic, the lockdown reopenings, they were a little bit choppy at first, but the way we always like to put it is that if your leg's been in a cast, when you take the cast off, you don't necessarily run immediately. You have to walk before you can run. So between the government has really slowed down a lot of its aggressive behavior towards some of the tech giants, and they are starting to try to stimulate the economy. There are definitely some positives catalysts that might spur a reversion to mean for what have really become a very deep value equity story.
I've got to ask you and I love the analogies, by the way, but just in terms of Starbucks, because I know that's one of your picks, and this isn't necessarily from a perspective on the weakness on the Chinese economy that we're seeing, because eventually it'll come back. Maybe now, maybe 5 years, 3 years, who knows. But just in terms of the trend that we're starting to see in China, where it comes to picking the national champions over the MNCs, whether it be, your leanings over your Nikes, whether it be your Xiaomi's over your Apples. Are you worried that's going to happen more and more with Starbucks, that they're going to be directed, I don't want to say directly directed, but go to Luckin instead of going to Starbucks?
That's definitely been one of the key factors that's hit Starbucks in the near term. But that said, I mean, we think of it just really from more of a bottom-up perspective, and as a result of that, it gives investors an opportunity to get a quality growth name. I mean, right now, Starbucks at 20 times earnings. Typically, it trades for 30 times earnings. It's trading below the broader market for the first time in quite some time. You've got a name that's been fantastic for returning capital to shareholders. Their dividend payout has grown by almost 20% per year for the past decade. You've got pricing power. It's challenging for all companies, but in the case of a Starbucks, you've got the dominant player in an addictive product. And I like to think of it self-servingly. When I'm on the road traveling for work, that's where I stop to take a break. My daughter does her homework there. My son hangs out with his friends there. In many ways, in the U.S. and increasingly overseas, Starbucks has become kind of the town square of the 21st century. So there's definitely a lot to like there at a discounted value.